Hello and welcome to the optionspreaders.com monthly podcast. I am Justin Cardwell, the Director of Research for optionspreaders.com, and I am joined today by our head trader and CEO, James Cordier. James, thanks for spending some time with us.
Always my pleasure.
Really appreciate it. I would really love to get into it quickly here if you would be okay with that. There's been so much happening over the last 11 months. And since this is our first optionspreaders.com podcast, I thought we could, have the luxury of grouping all of those things together and talking about what has happened in the markets. Obviously, a new Trump administration taking effect, and would love to get your thoughts on that.
Definitely. Whether you're talking about the stock market or, of course, commodities like we are today, I would say the entire kitchen sink was thrown at the market this year. From the taper tantrums in April, the tariffs that continued to go on throughout the year, changes at the Federal Reserve, just demanding lower interest rates from the administration. Certainly something practically brand new was on the horizon. Practically every month, everyone was kind of like waiting, like, well, what's next and what's next and what's next? Interestingly, interest rates are going to wind up dictating, I think, commodity prices as we go into the end of the year. I know we just had a single quarter point deduction recently, and there's discussion of more coming, but this year was probably an anomaly year. Many commodities were just going kind of sideways, like extremely steady. The grains were extremely steady. Even crude oil, with all the war and peace and propositions for creating less havoc in the world, oil simply hardly moved at all. I think it had about a $10 trading range, something that we rarely see, a low of like 60, a high of 70. I think the administration had a lot to do with that, actually. President Trump visited Saudi Arabia more than once, and all of a sudden he came home with deals in his pocket. And I think that helps stabilize the price of energy quite a bit. I know consumers really look forward to having a nice, stable price at the pump, whether you are simply filling up your car to go to work or if you're a factory trying to understand what your costs are going to be. Stable energy is certainly a big plus for many consumers and, of course, for the economy.
Yeah, and obviously we've talked about the new administration coming in, and the media loves headlines. And whether you love Donald Trump or not, there are no shortage of headlines. You mentioned we're waiting monthly on what could happen. I feel like it's not even weekly. It's not daily. It could be hourly. The guy can tweet with the best of them, and he can really move the markets extensively. And we'll stay on stocks just for a second in the overall market, because many, potential clients come to us. They are heavily invested in the stock market.
Mm-hmm.
And we know that the media, they want to pull out the headlines. They love the big swings and the different stocks that are out there. And especially the AI push now has been so big this year.
Right.
And so these big headlines, these big swings are something the media is always looking for. And we don't see a single person affecting commodities the way that they can impact stocks. As an example, this last week, we have Michael Burry, famously as the Big Short, come out, and he's severely bearish, not just on AI overall in the valuation, but NVIDIA and Palantir specifically. And we saw them last week drop 6 and 7% just last week based really on that news. And that's just not something we see in the commodities markets.
It really isn't. Supply and demand are the fundamentals that dictate the price of gold or coffee or corn or copper across the board. Every once in a while, a tweet or some information can hit the market. Article in the Wall Street Journal can move the price of lumber from time to time when they're talking about housing starts like that. But for the most part, commodities are going to wind up trading exactly what their fair value is. And the reason why we know that is because there's an open outcry auction every single day. And if you're bullish, you get to vote that way. And if you're bearish, you get to vote that way. And at the end of the day, the market settles. And then they get to fight over prices the following day, and then they do. But commodities certainly, unlike other investments, they're priced right at their fair value. And that is why we spend so much time trying to understand what fair value is in these different markets, following supply demand for staples like coffee, cocoa, sugar, orange juice, gold, silver, crude oil, and natural gas. It's very valuable to follow these, understand what fundamentals are actually moving the market, and trade accordingly. And from time to time, for several days or a week or two, the markets might exceed or go below what their fair value is, but it always returns to what it is. And the reason why we know that is because end users, if something gets too low, they will start buying it. If something's getting too high, producers will start selling it. And it's a perfect system of capitalism, understanding and dictating the price of commodities.
Yeah, and I was going to mention that. That's at the end of the day, the difference between commodities and stocks, there is an end user. There is a definition of price, and every day we find out what that price is. And that's a stark contrast to what most people are used to, in the stock market, individual stocks. So let's get into some fundamentals here, some
Mhm.
things that we can track every single day. About gold and coffee today specifically. Both of them have seen all-time highs this year, so we're going to talk about those. Before we jump into gold, obviously the Fed is going to have a big impact on the US dollar. It's going to have an impact on uh, interest rates, obviously, on what we're going to do with those in the December meeting. And then the following meetings in January and March. I just saw that the expectation in January and March is for no cut, and there is a potential here in December for that cut. Tell the viewers how that's going to impact not just the US dollar, but also the gold rally that has been happening.
You know, Justin, I've been doing this for over 3 decades, and I can't recall ever a moment where stocks around the world are setting all-time record highs, as they are here in the United States, and there's a huge push to cut interest rates as the market's at all-time highs. Don't recall ever seeing that before. And what that tells us is that the administration and the Federal Reserve, with the new chairman coming on in a few months, is interested in allowing the economy to run hot, because you have a stock market all-time high. You still have some sticky inflation. Inflation has certainly come down over the last several months from where it was about a year ago, but it is still high in some instances. So the fact that we're going to lower interest rates, going into sticky inflation, going into a strong stock market, the administration really, really wants to get the economy running hot. And that's going to do one very important thing for the US economy. And the hope is to reinvigorate the housing market here. The housing market is such a huge proportion of the economy here in the United States. Housing sales are down, housing starts are down. And all you have to do is look at one of our favorite commodities, and that is lumber. And lumber is just diving in price right now. And that tells us the health of the housing market isn't very strong right now. And that is probably the biggest key to what the administration and the Federal Reserve, I think, wants to do. And that is get the housing market turned around. That creates so much wealth for probably 60 to 70% of the population here in the United States. And right now, they're really feeling pinched. Employment and jobs right now are getting a little bit sanguine. Jobs right now, jobs numbers back in September and October showed a definite slowdown. And at the same time, you've got debt amongst some of the lowest income earners. And that combination right now is eventually going to weaken the economy. The economy is as strong as the weakest link. And right now, some of these lower earners with high debt, they're going to start really having to rein in the spending. That, I think, is going to be the biggest driver in getting interest rates down another quarter, another quarter, another quarter. I know that Chairman Powell recently said, not so fast on all these cuts, but his term is coming up. With the administration's desire to bring rates down, I think that will win out. Once these employment figures continue coming out kind of on the weak side, I think that'll be the catalyst that everyone's going to say, okay, we need to get the economy running hotter. Let's invigorate the housing market, and that's with lower interest rates.
Yeah, and you're right. The housing market itself, if you just looked at all the commodities that are impacted by the housing market, it's pretty substantial. Not just lumber, but you've also got copper and obviously steel and the gasoline and the diesel that it takes to get these machines moving back and forth to transport this stuff just has such an impact overall. And you're right, it's about affordability,
Hmm?
right? For the housing market, it will be interesting. Ray Dalio came out just last week also and made a comment about the Fed expanding their balance sheet, quantitative easing coming into play. And of course, if they're doing that, they're making monetary policy easier, right? So that people can do this. And, if you've read his book, then you know that this is one of those things. And the debt that you're talking about, this opening, this easing of the Federal Reserve makes it easier for them to renegotiate these debts with these people. And I think that's what we'll see. Obviously, the 50-year mortgage, maybe next month, we'll be able to talk about the potential impact of something like that. I don't know how possible that really is, but it's something. Obviously, it's very important. So interest rates, let's say that they cut them in December. You've been quoted quite a few times now, and you've been on with CNBC even recently talking specifically about gold. And obviously, gold is a big one. That is one that's in the Wall Street Journal. How are the interest rates going to impact gold for 2026? Because that's the number one question here. What are people going to do with their portfolio with gold?
Interestingly, Justin, portfolios have always been managed, or often been managed 60-40, 60 stocks and 40% of fixed income. And it seems to be changing. And you and I have discussed this before. It's looking like 60-30-10, and the 10 is now alternative investing. And I think commodities are finding a really strong home into that 10%. For the first time that I can ever recall, the gold market, which made all-time highs already this year, reaching $4,400 an ounce. The main catalyst for that is the debt in the United States. As we approach 38 and 39 trillion dollars. As everyone knows, commodities are priced in US dollars. So if you think about it, I mean, sooner or later, a lot of investors think that this single greenback, of which there are 38 trillion owed back, when is that greenback going to stop getting the buying power that it's enjoying right now? And when does that finally fall? And central banks around the world have really had, yes, insatiable demand for gold, but for the first time, they don't care what the price is. Interestingly, prices for commodities will generally fix themselves. If they're too high, they'll come down. If it's too low, as we described a little while ago, for end users. Central banks, the higher it goes, the more they want. And when it dips, they don't care. They simply want to, I think, trade in their currency, of which a lot of people are holding US dollars, and just trade it into hard assets. The insatiable demand from central banks this year set a record every single month. And going into December, it looks like there'll be another record doing just that. As central banks want to get more gold around them, regardless of price, that tells us that the gold rally going into 2026 might actually continue.
Yeah, so obviously, we have a lot of people ask us what's going to happen with gold tomorrow. And that's not what we do. We're long-term fundamental traders. But there is something you could teach us about following open interest, why this is important, especially during a rally or even during a huge bearish move here. Why is open interest a key indicator, and specifically in something like gold? I think you could teach us a lot about that.
Interestingly, on CNBC a couple of weeks ago, I made the point that viewers there and our viewers today might want to keep an eye on open interest. What does that mean? Open interest is one contract that someone's long and one contract that someone's short. That equals one contract of open interest. Generally speaking, when the markets are going higher, fundamentals are strong, momentum's pushing the market higher, open interest will increase at the same time. What does that tell us? That means that it's new buying coming in, propelling the market higher. When gold reached 4,400 about a month ago, open interest fell approximately 12 days in a row. And as I was mentioning to the CNBC viewers a couple weeks ago, that means it was short covering. It wasn't new longs coming in. It was people that were betting on the market falling giant uncle buying back their short position. And that told us that that $4,400 rally was going to be short-lived and we were going to take a dip down. We did see that happen. Gold fell probably about $500 from its recent record high. Open interest has now reached a level where it has fallen to throughout the entire year. And that means, and when it reaches that level, that all the week longs, all the shorts that need to cover have all done that. And now we're sitting at an open interest level that basically is the floor, waiting for a catalyst, waiting for whether it's interest rates or central bank buying or what have you. And now this open interest starts flowing back into the market. And we just noticed that this past week. And thus we see the gold market rallying yet again. Open interest is like one of the favorite technical keys that we follow. We like Bollinger Bands and relative strength and MACD and all these different things. Open interest tells us whether the market's being bought by strong hands or weak hands. And that has been just a great barometer and indicator for us over the years.
Yeah, so for the viewers to check this on their own, September 22nd was the date that open interest was around 530,000.
Mm-hmm.
And we dropped to basically 449,000 at the end of October. And you could see when that rally took off and it just skyrocketed as open interest was falling. So and our next subject here is going to be coffee. This is probably something that we could spend an entire podcast talking about, especially all the headlines that have been driven with coffee. Obviously, it went to all-time highs, and it feels like forever now. We've heard about terrible weather, drought, flowers falling off too early, not having enough, energy, as Jonas, our buddy in Brazil, would tell us,
Mm-hmm.
not enough energy to support the cherries on the trees. Yet the Brazil harvest is completed, and there are reports anywhere from 55 to 65 million bags. This is a substantial amount, especially that 65 million number. Conab coming in at 55, other reports saying 65. So maybe it's in the middle. We'll say it's 60. At one point in the year, they were expecting 40, to 45 million bags. To see something like 60 million bags coming out of Brazil now, obviously that's going to have an impact here on our approach to the coffee market going into 2026.
Interestingly, Colombia used to be like the largest producer of everyone's favorite coffee, which is Arabica coffee. Robusta is consumed in Europe. It's kind of sour. Americans don't care for it that much. We like the sweeter brands that are produced in the mountains. Robusta is produced in lowlands, wetlands like Vietnam. Colombia used to be the largest producer of coffee, approximately 12 to 13 million bags. And as you just mentioned, we're talking about 60 and 65 million bags produced in Brazil. And that's why the weather there is so important. They produce approximately 60% of the world's Arabica production. So all eyes always are on Brazil. Last year, it was a terrible drought. We followed the weather patterns there all year long, and it was extremely dry. This year, fortunately, for the consumer, as traders, as we like following what trends will eventually be. Precipitation right now during the important flowering season, which starts in October, November, and December, precipitation looks quite good right now. However, there's a lot of angst right now thinking that coffee prices are heading higher. And we're not sure that that's actually going to happen. Part of the rally in coffee, of course, is the 50% tariffs that President Trump put on Brazil. And so buying companies here in the United States don't want to import that coffee. So it's kind of just sitting there. And what that does is it tightens the certified stocks here in the United States. Honduras produces coffee, Mexico does, Guatemala does, excellent coffee. But these countries are producing 3 million bags and 5 million bags. And Brazil is certainly the gorilla in the room, producing 60 to 65 million bags. So fundamentals right now are relatively neutral with a strong bias to higher prices the last 12 months. That seems to be flattening out a little bit right now. A lot of excitement in coffee is still here because of the drought that everyone was hearing about last year. Certified stocks are at a 2-year low. Sounds really bullish, but actually a lot of this is determined by the tariffs that we've just experienced. Our guess is like gasoline, like eggs, like meat. The administration is interested in holding prices down. And coffee, you and I were talking about this the other day, is one of the two or three commodities that people follow so closely. Someone talked to me the other day. It's like, a can of coffee used to be $10. Now it's $20. What gives? That's what gives. We've got a 50% tariff on Brazilian coffee, and that certainly has a little bit to do with it. I think President Lula in Brazil and President Trump here in the United States are going to wind up making peace. That is going to help bring coffee prices down probably the first or second quarter of 2026. So with this real exuberant, speculation in coffee prices right now, we think that's setting up great opportunity for the first and second quarter of 2026. We don't see the prices going nearly as high as some of the options that are trading right now. We think that's a really good opportunity over the next 4 to 6 weeks to get in.
So you made the comment about Robusta coffee and Arabica coffee. Many people probably don't know uh, that there are two different blends here. And we've talked about this. There could be more push towards the Robusta. It's easier to grow. And at the end of the day, people need the coffee, and whatever the blend is what the blend is going to be. But now we're getting reports from Vietnam that they could have a near record or potential record harvest of Robusta coffee. And we'll have a chart on the screen to kind of show what's happening with Robusta coffee here. But on top of what you just talked about with Brazil, even if they do hit the 60 million bag number, and on top of that, you've got more coffee coming from Vietnam than what was expected, that only amplifies this the cap really that is going to be going with coffee. So looking forward to what's going to happen here in the coffee market in 2026. I talked about this, and it applies to coffee, so that's why I want to talk about it now. The volatility that comes into these markets, it doesn't come in and then come back out. When something like cocoa goes on a rally up to 12,000, and now you see options that are on the board that are up to 20,000.
Right.
This is something that really hasn't been seen before, but there is the potential there. There are people that are bidding there because they feel this is something that could happen again. As option sellers and option spreaders, those of us that are trying to collect premium, how does this impact us? How are we approaching this when this volatility comes into the market in the years ahead?
Interestingly, Justin, when the markets are extremely quiet, a lot of people feel that is a good time to be selling structures and options, whether it's calls or puts, sometimes strangling the market. Ideally, when volatility is really low, you keep very large amounts of dry powder in your account because something will move the market. There will be some inertia that creates volatility. Once that happens, for example, the 100-year drought in Brazil last year, coffee options, because of the drought last year, are going to stay extremely, in our opinion, overpriced for probably the next 3 to 4 years. It just embeds historic volatility into the market. Coffee prices right now are approximately $4 a pound. If you go into spring and summer futures contracts for next year, it's $3.75 and $3.80. Strike prices for coffee in May and July and September of 2026 are trading at extremely high levels at strike prices of $8 and $9 and $10 a pound, 2 to 3 times the price of coffee. That is the volatility that we try and take advantage of as option spreaders, selling structures that are 200% above the current price. And that's just what we like to describe as low-hanging fruit in the industry. When volatility hits gold, copper earlier this year, coffee now, if you have a pretty strong understanding of the fundamentals in these few markets, you realize the chances of coffee tripling in the next 6 months. It's at all-time highs now. You have Brazil tariffs coming off likely. And lastly, as you mentioned, one of the largest coffee crops coming out of Brazil next year. The market could be flooded. Not only is $4 looking a little bit rich right now, selling option structures at $7 and $8 and $9 a pound, over double the price of coffee right now. That's low-hanging fruit, in our opinion. That's something that we're going to be taking advantage of here over the next several weeks.
Yes, went through this entire podcast. Next month's podcast, it will be a big one. We're going to get into more detail on what it is that we are doing on the trading side of things, how we're putting these structures together, and what our approach is going to be heading into 2026, and potentially how we would actually put these into motion for clients in their portfolio 2026.
Excellent. We're going to be doing that for our clients now. And in the next podcast, we'll tell our viewers how they can do it too if they choose to.
Yeah, and we'll have James here to do that for us. If you are not already a subscriber of optionspreaders.com, you can sign up on the website. It is free at optionspreaders.com. We have a free e-report and a free booklet that you could sign up for. You'll get all of our materials, including podcasts like this every month. You'll get newsletters monthly, and you will get all of our trading seminars and market updates on commodities that you could take action with. We appreciate you sticking with us today on our first optionspreaders.com monthly podcast, and we will talk to you again in December.